All right. Clearly, the markets have seen a good sentiment today because that's reflective of the advance decline ratio standing at about 3:1. And of course, from an index level, we have seen that both the Sensex and Nifty have been up by about 2%. But the crude oil prices still remain at above $100 per barrel. So where does that spill us for the Indian markets going ahead, and whether or not this rally can be sustainable in the upcoming sessions remains a key question. So to answer more of that, let's quickly move on to our next guest of the show to talk about markets and what lies ahead. Joining me is market expert Sunil Subramaniam. Sunil sir, good afternoon. Clearly, markets on a relief rally mode today. What's your first take on the markets today, and with the kind of rally we have seen, do you think it's durable going ahead given that oil is still above that $100 per barrel?
Well, I think this is more of is led by short covering, and I think it's a relief within a bear market space. I don't think this is a sustainable rally for the point of view that while Mr. Trump declared a 5-day pause, today, right through the day, there have been both sides of the argument. The tweets have been coming. Now we don't even know what to believe. There's some say that there were attacks today. Some say that Iranian government has agreed for talks, and then Israel is not agreeing. So I think that if you look at the barometer of the market, you correctly pointed out that it's oil, and oil is still at close to $102 per barrel. The dollar index is still at about 99, and US interest rates are also at close to 4.36, 4.37. So all of these mean that I would say that the rally today was a part of short covering because massive shorts got built up because of the tremendous crash over the last 2 days on Thursday and Friday. But more importantly, it's also a read by some of the players that the war is going to end. It's I would say a gamble on that, because if oil remains at this level, there's no way that the impact is not going to be there on Indian economy. It's going to be there on the economy, the fiscal deficit, the currency, the interest rates, RBI's policy. So sustainable oil, if remains at 102 for an extended period of a month or so, I think the damage will be far more. So right now the market is going on the optimism that since Mr. Trump has kind of backed down and it looks to be open to talk. So though there's really no specific good news coming today in terms of conclusive trade talks or a statement of ending the war, market is hopeful, and that hope is built into today's rally and a lot of correction, overcorrection. So while short covering explains the stocks within the F&O segment, outside also, as you mentioned, the number of stocks advancing, advance decline ratio was heavily in favor of advance. So clearly there's a lot of money rushing in to buy, saying, oh, tomorrow if the war is actually comes to an end, there will be a circuit up. So let me buy before that. So I think that's kind of a sentiment rally. We'll have to wait for the next tweet from Mr. Trump to decide on what's going to next happen in terms of the markets. And today was also, I think, the what do you call option Nifty, the expiry date.
Yeah, of course. We have back-to-back expiries also. Sunil sir, but how are you seeing the current sell-off on the Nifty? I mean, down from 15% from the peaks itself. Do you think it's the right time to build positions or wait until the oil price volatility is out of the way?
So I would say it's the right time to build positions, provided you have an outlook beyond the next 6 months. And also, I would say, I encourage you not to look at the stocks which have corrected most and so buy more of them. I would argue that you had a portfolio going before the war started for every individual investor, right? Based on your certain goals, outlook, time frame, risk perception. Are you aggressive? Are you moderate? You would have built a portfolio. I would say stick to the same, but yes. And I've been votary of buying in small amounts right from the day the war began. So I've been recommending that your free cash flow put in 1% per day. So the war lasts for 100 days, 3 months. You'll still be exhausting your cash, but you will be averaging the portfolio that you built. Because I believe that as soon as the war ends, give it another 3 months for everything to settle down, you will see that the Indian story will be back on track. Right? What we already have the EU deal in the bag. The US deal, for reasons beyond our control, is on hold now. But the relationship between India and US is on a good wicket. So I would say everything would come back to what is a pre-war level with a lag of time. So that's why I said have a clear 6 months that in my 6 months, I'm not going to look at my portfolio, but I will start buying, replicating my old portfolio every day. And so from that perspective, it is the time to buy.
Okay, got it. But from a valuations perspective, do you think that the risk reward ratio still looks favorable given that we have macro risks emerging, oil price volatility, and even rupee emerging as one of the worst Asian performing currencies?
Well, see, a lot of that has already happened. So if I look at it as an FII, for example, who are basically going to drive the future direction of the market, he'll say, oh, rupee is already weakened so much. What is the probability that it will weaken as strongly in the future? I would say that probability will come down because a lot of this bad news is in the price, right? But like I said, the moment the war ends, oil is going to correct. Now, whether it corrects all the way back to 65 or stays around 80, there are multiple opinions there. I'm on the 80 side. It'll come back to a levels of 80. That would ease a lot of pressure on the rupee. So the point is that right now a lot of the uncertainty premium is reflecting in that. So my sense is that from a valuation perspective, if you look at the risks, while the war is on, the risks are on, right? So clearly, any cent of valuation within a war time frame is not going to look attractive on the risk reward perspective. The moment you look beyond the war and you say, okay, 6 months, right? I'm assuming that the war will end in 3 months and you'll have another 3 months for everything to stabilize. That time the risk reward beginnings to look favorable. But remember that I think I was looking at the performance of the Indian markets with the emerging markets. On a rupee basis, India has outperformed the emerging markets. Emerging markets are down about 12%. We are down about 10. But the moment you take rupee depreciation into account, in dollar terms, our market is down 13% and emerging market is 12. So two aspects here. So whatever the India's valuation premium over emerging markets before the war, it's roughly the same, which is about 55 to 58%. So from a perspective of valuations, our getting below our long-term 5-year average or 10-year average is not relevant to an FII. The FII is looking at it relative to emerging market value because we get money from an emerging market pool. There we are still at the same level of relative valuations. The key point is when he does a fresh allocation there, the FIs who sold out, they had booked profits and sold out. When they make a fresh re-entry, he will evaluate India along with Taiwan and Korea and take a call. So at that time, I would say since the oil-related risk has gone away, the probability of the FII looking more favorably in India rises. Second, they got money because of the AI readiness or the proactiveness in AI, which India was perceived to be not. Now, after the war, they're also going to take time to get back to that because AI is heavily power hungry. And I'm sure the oil price rise has hurt them also in terms of what they do. So I would say the situation post the war may look better for India, though our valuations will still look about the same as before the war. The outlook for the future maybe look better, and so FI flows may tend to come back. So that's the way I would say from a risk reward. And mind you, within the FIS, you do have the short-term hedge funds. Now, who've been selling? People who are making money from shorts, right? And they're not long-term investors. But if you look at the pension funds, and I looked at data from the beginning of March to now, we heard about lack of crores of SISL. But when I analyzed the data and disaggregated the purchases from the sales, that 1 lakh crore represents a 20% gap between sell and buy. So which means what? 60% of the money the FIS were dealing with in India was selling, 40% was buying. So that 20% is their 1 lakh crore, if you get my point, right? So 5 lakh crores was the total pool. 20% of that is what is 1 lakh crore. So why my point is, right through this most volatile period for the Indian markets, 40% of FII money has been buying. Now, what does that mean? Who is buying? It's the pension funds and the insurance funds and the longer term funds who already built a portfolio which has a certain portion of India and within India a certain section of sectoral allocation. So they have been continuing to buy that same. That's why when I gave my answer earlier about what we should buy, I said replicate the portfolio. Because these FIs who are 10-year outlook are not going and buying paint or tires saying that's come down more and buy more. They are buying the India growth story and we should also stick to the same. And on that basis, right, the valuations haven't got worsened. They are still at the same level. So I'm of the view that long-term FIs are continuing to buy. Domestic mutual funds obviously have been strong buyers. Even this month they've crossed a lakh of crores. So as an investor, you should just follow the big money, which is the long-term money. The short-term money will always punt on currency, inflation, interest rates, whole lot of things.
Okay, got it. But Sunil sir, at a time when even the tariffs are not out of the way for India, and then we have a stronger dollar also, and then US 10-year yields inching up to about 4.4%, does that remain a key challenge when it comes to the capital flows looking back at India?
Not really, because I would say that, see, it's right now, even the US, the Fed's hawkish
Hmm.
hold was a
Yeah.
function of the prices being high. And, they're factoring in that into that. If the war is over, US inflation will also come down because gas prices will trend down. And you will have the Fed rate cut back on the table as a discussion point. It may happen in by September or December or whatever, but once a future rate cut is in the pipeline, the interest rates will start to ease, roll back. The dollar will also start to weaken from its levels. So I don't see that as a big challenge for capital. And for India, see the trade deal today, thanks to the Supreme Court judgment, India is on a level playing field with the rest of the world. So tariffs are not negative only for India, they're negative for the whole world who's suffering a 15% tariff for the 150 days. Post 150 days, what happens? How does the Trump administration propose to levy tariffs, whether it's a Section 232 or 301? We don't know that yet. But we are not unduly harmed by the tariff because every other country has got 15% tariff.
That's right, that's right. So, yes, sir, but if indeed the war prolongs to early April, what is the kind of earnings impact that you're assessing, especially for the corporate India?
So earnings expect is obviously not across the board. It will be
Hmm.
restricted to paints, tires, aviation. So I would say the hit on aviation for this quarter will be quite high because it's not just been the aviation cost, the fuel cost, but it's also been the ban on travel through the Gulf. So clearly, they are high operating leveraged segments. So clearly, they will take quite a severe hit on this quarter's earnings come April if the war is sustaining. That's the oil-related sector's earnings impact. I would expect at least 20% impact on their EPS for the April quarter if the war lasts till then. Because we are already almost in by the end of March. So most of the damage is already done. So I'm not sure that the next 10 days or something is going to retrieve it. So basically, those segments are going to look not so great. But bear in mind the market deals of consensus. Consensus forecaster will be factoring in this. So while the QOQ earnings will come down,
Hmm.
the versus consensus, it may not be that bad because market participants know that there is an impact. Right? So to the extent, sometimes a lot of times market reacts to versus consensus as opposed to just the trend line EPS growth, right? So that's that. But apart from that, from a segment like banking, for example, it's got hammered for unrelated reasons, either because India's got sold off. So 35% of the index is banking and financial services. So it's got sold off. Or because of that one particular bank and the what happened to the chairman resigning and all of that, and then negative spill over that. But that's nothing to do with the EPS growth. So I think banks will report another solid quarter of growth come April quarterly results. So that will be good. I also expect that the summer outlook for the cooling related consumer durables will be very good. So while the earnings will not reflect that, the commentary will tell you how those the GST cuts are playing down. So it's a largely domestic, but some consumer durable companies obviously have import costs of crude affecting their margins. So there will be some impact on their margins for this quarter, but the outlook could be very positive for consumer durable, specifically the cooling related segment in for the summer months.
Okay, got it, got it. So, Nilsa, earlier you were talking about, how crude sensitive sectors are going to get impacted on the back of the oil price volatility. I mean, today we had Asian Paints raising price hikes by about 7 to 8%. And earlier we did see some of the OMC companies also raising their premium fuel prices, though the retail prices have not been changed. But do you think that it's enough to offset the pressure that we have seen in terms of the input costs? And what does it lie in terms of the margin pressure going ahead?
No, no, I don't think that these hikes will compensate fully. It'll only
Hmm.
partially take. You look at the price, what's the increase in the price of oil? It was at $70. We're at 105. You're talking about a 50% increase in the cost of the crude inputs. And here you're talking about 5 to 7% retail prices, the retail end of the manufacturer. There's no way that you can pass on a 50% input cost increase in terms of that to the consumer. Your market shares will fall, your consumer demand will get hurt. So the corporates will have to absorb some of the pain, and pass on some of the pain. So it's a balancing factor. So I do think that as far as this quarter is concerned, there will be an impact. But like I said, it may not reflect in the share price correction because market is already aware of this information and the consensus estimates of EPS would already be altered.
Hmm. Okay, got it, got it. All right. So, we can see some pressure going ahead in terms of, despite the price hike that they have announced. Okay. Sunil sir, also apart from crude sensitives, let's focus on IT sector. We had a note from JP Morgan where they see that FY27 guidance will be a key trigger instead of the Q4 numbers to set the tone. And given the kind of correction we have seen in the tech stocks, do you think now the kind of growth we'll be seeing that will be supportive of valuations, or should the entire sector wait for further reset?
No, see, what's happened there in IT is that the AI overhang obviously remains. And the AI overhang is not about next quarter's results or even next year's results. It's about results 3 years later when
Yeah.
your user companies get comfortable with AI and they start directly implementing the AI solutions that are coming to the IT companies. It's also about the fact that IT companies can no longer start be billing based on per employee or per hour, but on a contract basis. So this change in the business model will involve resets. The companies will also have to put pressure on their employees that either they become AI ready or they get laid off. So we're going to see quite a challenging time for the IT sector in terms of all of this. The quarterly earnings, the yearly guidance is a little more important because by last quarter of this FY27, right, some pressure could be there. So the guidance will give you a clue as to that. So from a point of view of that, what I feel is that the IT sector correction and the AI overhang has made a fundamental shift in the IT sector's positioning in the market. Post COVID, it had got speed as a growth sector because the world was turning into Internet of Things, everything was working from home, and whole sort of rejigs will be done. So it had become a very phenomenal growth sector, and that's what it is. But prior to COVID, if you remember, IT was a stable sector, more of a value driven sector, right? Today, IT has gone back to that place. IT is now, because the dividend yields are still strong, there's been correction, and their core revenue model, it's a while the nature of the model for fresh business will go, they still have old contracts which are going to play out over the next 2 to 3 years. So the immediate impact on their revenues will not be so bad. So what will happen is that they've come into a, I would say, margin of safety zone where value oriented investors, institutional investors who want income seeking stocks, right? The pension funds, for example, right? They will find IT an attractive. So there will be buying support to IT from that segment, which is not the growth segment. But the growth segment is obviously going to continue to sell off. So there will be a trade-off between the growth versus value investors. But this fundamental shift will enable the IT correction to be arrested. It will not correct much more. So as an investor, you can look at IT as a part of the value component of your portfolio, not so much the growth component. Now, to the extent that the mix of investors has value as an important criteria, IT could get continuous buying support and hence some kind of a floor in terms of the price would get formed. And that's where the FY27 earnings, if they come in better, it makes the situation better from a valuation perspective and for the value investors. But for it to get back to being a growth part of the growth pack, right, we'll need some of the IT companies to come and make a major acquisition, major announcement on how they're going to transition into this new AI phase, and some big mega plans have got to do to correct the perception that IT companies are not AI ready, right? Which is there, whether you help it or not, it's there in the marketplace.
Okay. So while the street has been viewing IT as a contra bet, despite what you're saying that it could be a low growth sector going ahead from here on. I mean, what would your advice to investors be when they look at IT sector? I mean, should they hold on until they see clear visibility when it comes from AI related growth story?
Yes, like I said, every investor has to have a growth and a value component. You can't be 100% on the growth part. So I would say shift the IT exposure that you have into your value component. And maybe you want to get rid of something else which you held for value. Okay. But keep IT as a core because I don't see that there's going to be a sharp drop off in the earnings. There's going to be stability to the earnings. Okay. So keep it as a value part of your portfolio. Now, based on your own outlook, if you feel that there's too much IT related to how much I want to hold value, then you can get rid of the excess. But IT, don't get rid of it completely because, like I said, I believe every investor should have a value component and a growth component, because value is the one which has a margin of safety, protects him during volatility, and IT will continue to provide that support. So I don't jump. But if you have held too much of IT, thinking that it's going to be the growth sector over the last few years, obviously not in the last 1 year, because the bad news has been coming in over the last 1 year, then I would say yes, you can pare your portfolio down to a level where you're comfortable that as a value pick, IT can be in your portfolio. So don't panic and sell. That's my advice. Keep it to the proportion that a value has to have a share in your portfolio mix.
Okay, got it, got it. So, yes, sir, I know you don't comment on individual stocks, but HDFC Bank, today the stock is rebounded after 4-day fall. Fundamentally, nothing has changed so far, but valuations, they have turned favorable. That's what everyone has been indicating. I mean, in terms of risk reward ratio, how are you finding it at the current levels? Anything that you have?
I don't comment on stocks, so it's hard to say. But what I would say is that the stock itself hasn't performed for quite some time, independent of this. And this
Hmm.
is something that's come on top of it. See, it remains India's best managed bank by a distance. These are events which have happened, are all specific to certain selling practices, which in a large organization is difficult to control given the aggression that private sector banks have over public sector. And I would say that even if you look at the reaction of the markets and the FIIs, it's not only to punish this one bank, they punish the sector itself, because what they've got is that, is this going to be something that's going to affect other private sector banks? And my answer to that, because I've been a banker for 20 years before I came into the mutual fund industry, is that these are all at a very ground level selling practices that have happened, which have come to bite. Like the 81 crisis was clearly one such thing, where before Yes Bank collapsed, nobody thought 81s are going to default, and they said, here is a nice pick up over your FD rates for a debt instrument compared to what else is available. And they look at a bank name, and a bank is issuing 81, they go and sell it. Now, the level of mis-selling happens at the salesperson's level, where he goes and says, sir, this is like a bank fixed deposit with an extra return, right? That's mis-selling. Whereas you position
Hmm.
it as a risk-based debt instrument and take the risk. 181 has failed, but number of large good banks like State Bank have issued 81 bonds. No problem there. But that's what I said. So this is a very localized selling related, some people are missold, and there has been, I think the bank has taken action on that. I don't think there's anything fundamentally wrong with the bank. I think it's one of the most aggressive, well-managed banks. So no issues as far as that is concerned. But like I said, to me, the whole financial services sector getting impacted by this because of the negative is given a good opportunity to buy into the sector stocks overall. But like I said, I don't want to give any specific recommendation on one particular bank.
Okay, got it. But we have seen that PSU banking stocks have severely fallen when it compares to the private banking lenders. I mean, going ahead, how do you see the scenario? And of
That's
course,
for a different
yeah,
reason. Yeah,
yeah, go
that's
on,
for a
sir.
different reason. That's because of the spike in yields.
Yeah.
That's because
So,
of the spike in yields. As you know, the 10 has gone to 6.85. All these banks, over and above the SLR, they have been holding
hmm.
on to G6, right? When they mark to market, there's going to be an impact on the P&L. But honestly, that is, I think, the fact that it's also a part of profit booking. See, DIs also in this whole thing have been net buyers, but they've not got enough money to keep buying what they want. They've done 1 lakh crores. They would have loved to buy 2 lakh crores. So they've been booking profits in segments like defense and PSU banks also. So PSU banks are also suffering from the fact that they've been the best performing over the last 2 years, 3 years. There's a big index of the best performing index. So they've been suffering a profit booking because of that. And this news around the interest rate hike, RBI may not cut rates or may even hike rates, those kind of news flows floating around has put a pressure on them to correct. But the business prospects of PSU banks, I would feel, are still solid. And given the fact that in a post-war scenario, the Indian economy's growth has to be on the capex cycle be funded by the PSU banks. So I still believe that these corrections that have happened in the PSU banks are a good time to start acquiring PSU banks also.
Okay, got it, got it. So, financials and consumer durables, these two are something that you're bullish on. Anything else that you're finding good opportunity in this meltdown?
So I think the capital goods and the industrial space there, because I also observed
Hmm.
in some data that FIS have been buying into those while they've been selling a lot of other sectors. And that's again because the long-term story of India needs that capex cycle to go up. And I think that uh, consumer durables I mentioned in the sense of in this quarter, summer quarter will be good, right?
Yeah.
But on a more longer term basis, it's the capital goods and industrials and the infra space which I believe holds the opportunity because that's where a V-shaped recovery or a Y recovery will happen. So I think that trusting your faith in that, and they are the ones who are not very badly affected by the oil price hike or the geopolitical tensions. So I would put my bets around the banking and financial services and the capital goods infra space as my pick and consumer durables with a more shorter term view of the immediate summer.
Okay, okay, all right. On that note, pleasure talking to you, Sunil sir, like always. Thank you so much for joining us.
Thanks a lot. Thanks, Lavisha.